Okay, folks, here we go again. Today it's been announced that UK interest base rates at the Bank of England have been increased by 0.5% to 1.75%. What does this mean to you? And what does this mean? And why do people raise these interest rates? Why does the Bank of England do this? Let's go into this a bit more detail and how this will affect you itself. So interest rates have actually risen for the sixth time in a row from 1.25 to 1.75%. The Bank of England's decision to increase rates by 0.5% means it's the largest increase for 27 years. Perspective, remember. Because before 27 years, I'll show you what happened. The move is an attempt to slow the rate at which prices are rising, and the bank itself has warned that inflation could pass 13% later this year. Again, I'll show you some information to actually demonstrate why you shouldn't be panicking that much. The last time interest rates were this high was during the global financial crisis in December 2008. Yes, okay, but December 2008, the last time they were that high was on the way down. Let me show you some charts to actually demonstrate that, because it's all smoke and mirrors when they want to justify their position, and they want to justify exactly what they mean at the Bank of England or in the news itself. But I'll show you some figures and I'll show you some graphs to show you where interest rates were. Let me just share the screen here. Okay, so here we are. I'm just going to pop onto here. Now, this is the interest rate, base rates from January 1992. Look at that, 11% base rates in January 1992. Look how it's come down over the years, all the way down. And even when you think about it, at the credit crunch, which is here, base rates were still sitting at about almost 6%. And then it dropped like a stone to the record 0.5% or 0.25, I think it was. And then, no, 0.5% here or something like that. And then it dropped to 0.25 and then it started to climb up again. And then it dropped again because of the pandemic. And then it started to climb up again. That's why we're at 1.75%. But look at it in perspective to previous years, all the way from the credit crunch back. It was a lot higher, significantly higher, more than 3 times, possibly even more than 4 times, and even more than 6 times at some point in time back to 1992. So perspective, first of all, that's what we've got to think about this. But why does the bank raise interest rates? Well, they actually raise them apparently to help lower inflation. Prices are going up quickly worldwide as COVID restrictions have been eased and consumers are now beginning to spend more. Many firms having problems getting goods to sell, and with more buyers, supply and demand, chasing fewer goods, prices have actually risen, and that's what happens. There has also been a very sharp rise in oil and gas costs, a problem made worse by the Russian invasion of Ukraine. So why are prices actually rising so quickly then? Well, one way to control the rising prices or inflation is to raise interest rates. So this is why prices rise so quickly. So in order to control that, they actually raise interest rates in order to curb that. This increases the cost of borrowing and encourages people to borrow and spend less. It also encourages people to save more, because if base rates go up, then interest rates on savings can go up a little. To be honest, it's not going to be that significant. So I can't see anybody thinking, wow, I've got to save loads of money to get 0.5% in my bank. I can't see that happening at all. Maybe 0.5% excites you, but I'd rather probably just have it in my pocket and do something with it. Because it's probably worth more to me like that than it is actually leaving it in a bank. After all, the bank runs along to me straight away and says, would you like to borrow the money that you've just put in your bank account and then give me a wee bit higher rate, and then I'll go and then use it and I'll make 15% net return on it in property investment. So that's how the banks work, and that's what happens with your savings when it goes into the bank. They lend it out almost 10 times to different people. And this increases the cost of borrowing, encourages people to borrow more, to encourage people to borrow and spend less, as I said, and actually encourage them to save more. Time will tell. However, it's a tough balancing act between the bank. They don't want to slow down the economy too much. And since the global financial crisis of 2008, UK interest rates have been at historically record lows. Last year, they were as low as 0.1%. So how high could interest rates go? Well, many analysts have actually predicted. Actually, let's look at inflation. Let's look at this wee graph of inflation. I'll pop that back on, and we'll look at inflation, and then we'll compare inflation to interest rates. So there's inflation there. Now, you notice back in 1992, inflation was sitting at about 8% as well. And so in 1980s, and early 1980s, inflation was sitting at 18%. And then in 1992, it was sitting at a high of just over 8%, which is round about where it is now. And it was an equalization all the way through, and inflation was kept down all the way through there to lower rates around about the 4% level, probably less than that on average over the years. Now it's started to spike as a result of that. And we're going to look at a wee graph later on of what that means with that spike and interest rates versus inflation. So how high could interest rates go? Well, most analysts have actually predicted UK interest rates will rise this month anyway, which they did. But further increases are also expected later on in the year. But that's what they believe. Analysts at Capital Economics think the bank will ultimately lift rates to around about 3% to quash inflation. But other economists think they won't have to go that far. Pantheon Microeconomics reckons interest rates will peak at 1.75%, where it is right now. Last year, the Office of Budget Responsibility, the government's independent economic advisor, looked at what might happen if the UK were to experience higher and longer-term lasting inflation as well. And they've looked into that and forecast and extrapolated already for that. This has happened. So this has actually can happen when people think price rises will continue, businesses rise prices to keep making a profit, and the workers demand wages increases to keep up. So costs start to escalate within the companies. Therefore, they have to put the prices of their goods and services up because people want that. And then what happens after that is then people then demand more money because they need to pay more money for pricing goods and services. But then that knocks onto the people that make the price of goods and services again. They have to put the prices up again, and then people come back and say, "Well, I need to get more in order." And you can see how that spiral goes up. So it has to kind of stop somewhere or slow down somewhere. If this happens, UK interest rates could actually hit 3.5%, the Office of Budget Responsibility said. So how do interest rates actually affect you? Well, mortgages, for example. Just under a third of households have a mortgage, according to a housing survey the English government, UK government conducted, which is geographically limited, but one of the most comprehensive guides available to actually demonstrate that. Of those, 3/4 have a fixed rate mortgage. Now, in Fife, in Scotland as well, there's about 17 out of every 20 people have a fixed rate mortgage as well. So it will not be they will not be immediately affected. The rest, about 2 million people, will see their monthly repayments rise. Now rates have gone up to 1.75%. Those on a typical tracker mortgage will have to pay about £52 more per month, which is round about £600 per year. Those on a standard variable rate will see their mortgages rise to round about £60 a month, which is round about £720 a year extra. This comes on top of increases following other recent rate rises. Now, compared with pre-December 2021, tracker mortgage customers could be paying round about £167 per month, and variable mortgage holders round about £132 per month in terms of that. Oh, okay, so the next one is, my chart here is to show you UK and inflation versus actual base rates. So here's base rates in the orange line. So see in April 2008, this was just before the crash. So what happened here with interest rates is the crash happened and it dropped like a stone. But you notice interest rates were up at roundabout, base rates were roundabout the 5.5%, 6% level. But did you see inflation climbing up there at the same time? So inflation was round about the 5%, just over about 5.2 or thereabouts. But then as interest rates started to drop, as the economy started to drop, therefore inflation started to drop because people spent less money. So you can see how that can happen. So this is what the government's trying to do. Now, a one-club approach isn't really the way forward. There is other ways and other tools to do that. And the government and the Bank of England actually know how to do that. They're just reluctant to do it because it might not be a vote winner for them. And that's why they don't want to do it. And they just want to use the interest rates to do that. But normal economists actually believe by the time you raise interest rates, you're too late because the damage has already been done. Because it's almost like a ship leaving the harbour and setting sail. Once it's gained momentum, it takes a long time for it to slow back down before it hits the next port. And that's why a lot of ships actually stop way beyond and actually just let themselves guide and float into port off their own back. Whereas that's the same with the UK economy, and the same with every economy, is that whatever it's going to be is going to happen regardless. It's a bit late to actually apply interest rates, but they can only do their best in the current circumstances based on the information they know. But you can see how inflation with the blue line here has actually gone up and down over the years, but they've never bothered to raise interest rates at all. It's only now because inflation's taken off. But again, I go back to perspective about where it was at the credit crunch and where it was before the credit crunch, and also in the 90s as well, and even in the 70s as well, where inflation was really high. Now, there's a lot of factors. One, for example, is the gas and electricity price and utility costs, which we can't control at all. Because that's borne out by the crisis that's going on with Russia invading Ukraine. And that obviously causes oil and gas prices, and because there's restriction in supply, therefore there's still that demand, therefore the price goes up as a result. Plus the fact that OPEC, which is the Arab nations of the world, they have a what they call a cartel called OPEC. Now, a cartel is where they sit. Now, cartels in Britain are illegal. And cartels in Europe, I think, are illegal as well. And it means that what they do is they all get together as the people that own and deliver the oil in the Egyptian countries and the East itself. They actually control the oil and the oil prices. And what they do is they all sit around the table and say, I tell you what, we're going to raise the price of oil to this amount, or we're going to produce less barrels, or we're going to produce more barrels of oil in order to manipulate that oil price. So they actually do that. Now, that is completely illegal in Europe, and it's completely illegal in this country as well. But because we're not that far reaching, we can't do anything about that at all. So they have control of the oil prices as a natural result of that. And hence the reason why they've kind of got us over a barrel. We do have North Sea oil, but we seem to be reluctant to do anything about it. But that's another story. Now, credit card and loans, how does this affect you? Even if you don't have a mortgage, changes in interest rate could still affect you. The Bank of England interest rates will also influence interest rates charged on things like credit cards, bank loans, and car loans. Even ahead of the latest rise, the average annual interest rate was 20.23% on bank overdrafts and 18.5% on credit cards in June. Lenders could decide to increase these fees now that interest rates have risen as well. Savings, how does it affect you with savings? The bank's decision also affects the interest rates people earn on their savings. Individual banks usually pass on any interest rate rises, giving savers higher return for their money. Don't hold your breath. However, for putting people's money away, interest rates are not keeping up with the rising prices. That's why I says don't hold your breath. So how does the Bank of England set the interest rates? Well, interest rates are decided by a team of 9 economists. That's the Monetary Policy Committee. And they meet 8 times a year, roughly once every 6 weeks, to look at how the economy is performing. The decisions are always published at 12 o'clock on a Thursday. Now, are other countries raising interest rates? The UK is affected by prices across the globe, so there's a limit as to how effective UK interest rate rises will be. However, other countries are actually taking a similar approach and have also been raising interest rates right throughout. The US Central Bank actually has announced a big rate rise in the last couple of months. The Federal Reserve, that's what they are, increased rates by 0.75 of a percentage point, which is 0.75 in June, and then again in July to a range of 2.25 to 2.5%. European Central Bank has also raised rates for the first time in more than about 15 years, actually. So all interest rates going up. It possibly might encourage people to save. I don't think they're that big interest rates on your savings probably to write home about. I think more people will continue to invest and spend or use their money in a more proactive way, if that makes sense. So hopefully that'll give you an insight into why this actually happens and what happens and where we are right now. But again, I come back to saying about interest rates and stuff like that. 17 and 20 households are actually on fixed rate deals. The majority of them are actually on 5-year mortgage fixed rate deals, So that won't have an impact on them at all. So whether they'll curb their spending or not is an entirely different story. But the only thing it will affect is probably the impending gas and utility prices, which will go up by about 64% in September next month. So just be careful of that. Richard and I are going to be doing how to survive the cost of living crisis, or how to beat the cost of living crisis, actually, on our wealth creation show on Monday. We just talked about that subject this morning and agreed this is what we want to talk about on Monday on our wealth creation show at 12:30 live on these channels. So Richard and I will be talking about that. And this will be based on my experience over the last 30 years of when I first started out and what I did in order to make sure I conserved cash flow and make sure I had cash flow all the time, but also make sure I was able to survive over a longer period of time and actually have enough money to then keep reinvesting in what I needed to reinvest, come hell or high water, and regardless if it was a recession or regardless if it was a boom economy or regardless of any economic circumstances. So I'm going to be talking about that through personal experience at 12:30 on Monday on the Wealth Creation Show. So watch out for that at that time. And if you've got any questions, please feel free to pop them in the chat service in the comments. If you get a chance, hit that like button, give us a like, give us some love or something like that, give us some feedback about if we're doing the right thing. Also, if you want to make any comments, contribute comments about inflation or how it'll affect you, or interest rates and how it'll affect you, utility costs, how that'll affect you, mortgage rates going up, how that will affect you as well. Please feel free to put that in the comments. We'd love to hear from you as well and get feedback into if we're going the right direction, if we're saying the right things, and if we're being helpful in terms of where you are in your journey. And until next time, guys, I'm Jim Parker for